How are you looking at the auctions over the next 48 hours?
You know, it's amazing that we have to pay so much attention to this now. If I said to you, hey, we really need to watch the Treasury auctions last November, you would have said nothing ever happens here. The problem is we've gone from 2.4 to 2.9 in a blink on the yield on the 10-year, and that's caused some linear thinking, and that linear thinking goes something like this. If we can move that quickly, then obviously yields are going north of 3 on the 10-year. To me, the most important piece of the information here is that how long do we settle into the new level that we're at, right? So we exploded into 2.9 on the 10-year, and actually the spread between the 2 and the 10 has broadened out a bit, which I think is very important. That was the boogeyman last year. Now it's, are we going to blast through 3%, which, by the way, I don't think is a line in the sand for anything. So I think we pay close attention to all of the auctions now, and we certainly pay closer attention to things like hints of inflation, commentary around inflation, and the Fed minutes that come out later on this afternoon.
So, Art, as best you can, sort out two different things. How much of this is the underlying economy, sort of threats of inflation, wage increases, things like that, on the one hand? On the other hand, just the Treasury borrowing a lot more money at the same time that the central bank, the Fed, is sort of getting out of the business.
Right. I think it's both of those things in equal measure. I think it also is commentary we're hearing from the Bank of England, who sounded slightly more hawkish in their last communique. The ECB certainly talking about August being the end of their quantitative easing program. So it's not just our central bank and where we're headed, and we're clearly heading, to raise rates at least three times this year. The economy's improving. That's important too. So rates go up for the right reason. That's economic growth. Rates that go up for the wrong reason, anticipating things that might not happen at the Fed. So I think there's a fine line there, but I think it's all of those things, including global central banks.
So you said that wasn't necessarily the line in the sand. There is a line in the sand somewhere, whether we know where it is or not.
Yeah.
At what point do you start to get pretty nervous?
I'd wake up at 4%.
4%
on the yield on the 10-year for sure. Yeah, it's interesting. So we sort of painted ourselves in the corner 2 weeks ago, or 3 weeks ago, when the jobs number came out, and we saw a hint of inflation in the wages. And ever since then, people have been saying, oh, wait a minute, if we get 3%, that's the end of the universe, which is crazy talk. It's just that's where we've been for the last 7 years. So when, it was not long ago that you'd say, if yields get to 5%, they might start attracting money from equities into fixed income. That number's never been 3% anywhere close. Now, in this new world, in this new normal, maybe 3.5%, but I would say wake me up at 4%. I think that, we continue to paint ourselves into a corner that doesn't really exist. I think we're going to be fine at 3%.